Most traders think trading is about finding the right setup, the right stock, the right entry. It's not. Trading is about risk, because if your risk is wrong, everything else falls apart. Nothing else matters. You could totally be on the right direction and still lose money if your sizing is off. Professional traders like myself, we lose all the time. We embrace it. The difference is that the losses are small enough that they don't matter. In this video, I'm going to show you exactly how professionals manage their risk, why most traders blow up, and when rarely it makes sense to increase size. If you get this part right, everything else in your trading gets easier. Let's start here. Risk is everything. Risk determines your survival. If you survive, you can improve every day and get that 1% better. But if you blow up, it's over. You're taking months of vacation, sitting there, getting depressed, studying, and you don't get that time to improve a little bit every day. Most traders focus on entries. Professionals focus on risk first. Guys, your edge isn't some magic setup. It's staying in the game to get better. When you are a trader, it's just a race against time. Your capital is up here and your skill level is down here. And what you need to do is increase your skill level while your capital is still reasonably high. What happens with most traders is they start trading and they just lose money too fast while their skill level is slowly increasing. And so what happens is they never get past that area, that hub where everything starts to connect and you start to make some real incremental progress. Most traders don't actually calculate risk. They feel their size. They size up when they get excited. They size up when they get angry. They size up when they have FOMO. That's just guessing. Professionals size based on structure, not emotion. If you take random sizes, then you will have random results. If you have structured sizing, then you will have probability and structured results, things that you can depend on week after week, day after day. No single trade should matter that much, not emotionally, not financially. If one trade can ruin your day, your week, your mindset, you're trading way too big. That's the simplest rule in trading. I always tell myself, if I I'm willing to skip my nephew's soccer game on a random Tuesday, I've lost too much. I've bet too much and it's thrown my day off, and I'm willing to forego my family responsibilities on some basic things like showing up to your friends' kids' soccer games. That's when you've taken on too much risk. You don't want one trade to just ruin your day. Most traders will risk around 0.5 to 1% if they're a true professional. Not 10%, not all in, not I love this setup, I love this pattern, I love Tesla. Guys, trading is a long game. You need hundreds of trades to play out your edge. Small risk keeps you alive, but it also puts you in the position to become a big game hunter when that unique opportunity comes by, which I'm going to show you in a few slides, where you can go and increase your risk. But to get to that point, you have to bet in a standard way. I like the 1% risk because it's just easy math. You know, if you have 4 positions in your portfolio at 1% risk, if shit hits the fan, you're going to lose 4% of your account. That's not the end of the world. You know, that's your worst case possibility. That's something that you can handle. You lose 3%, 4% of your account on a few losses in a row, you can come back from that. And you can come back from that quickly. But if you lose 30% or 40%, it's going to take you months to get that money back. Small losses, they don't hurt. They don't shake you, and they won't change your behavior. It lets you stay calm, consistent, and objective. That's the real cost of doing business. The thing with trading is if you make it where it's an emotional roller coaster, then you're giving yourself an opportunity to make a big mistake. When you trade small and you're feeling really relaxed in your trades, you are not putting yourself in that position where you can do some real damage, where you have that slip up because you're not in the right mental frame to make good decisions. Usually in trading, one bad decision begets another, which begets another, which begets another. And at some point, something bad really happens, right? It's like a waterfall effect. You start doing stupid stuff, then slightly a little bit more aggressive, and then one time you'll just do something incredibly stupid and you're out of the game. Look, you can have a great setup and still blow up from oversizing. If you risk too big, one loss hurts. 2 losses hurts more. 3 losses starts to change your behavior. You start acting like a little bit of a lunatic and you start trading very emotionally. Oversizing doesn't just hurt your account, it hurts your decision making. It's when you start to fall apart and really do some stupid stuff. Every trader hits losing streaks. That's part of the game. Even the best traders in the world. The difference is professional traders survive their losing streaks. Retail traders don't. They're constantly going on losing streaks and then refilling their account. Let me get a new prop firm challenge. Let me get a new Webull account, a Robinhood account. Oh man, I got to take double shifts on Uber now. Save up for a new account. They're constantly in the game of taking some trades, making some money, oversizing, then boom, they're out of the game. Then they got to save money for a while, build up some capital. They get hot for a while, then boom, they oversize and they come back. I've taught 7,000 traders in my trading career. I have seen this pattern on and off. You trade, then you have to take a break, save some money, you come back. Well, guess what, guys? Those 6-month breaks that you keep taking while you're refilling your account, you're missing key time as a new trader to get that 1% better every single day. If you could just stay in the game and keep stacking these 1%, where will you be in that 6 months if you didn't blow your account? If you weren't on that spin cycle of new account, bust, take a break, new account, bust, take a break. That is the one that can make you sit there and try to learn how to trade for years and years. And frankly, I've seen that. I've seen people spend 10, 15 years trying to figure out how to trade with no progress because in reality, they're taking way too many breaks in the middle. Big size creates emotion. When you're all in on a trade and the size is big, you hesitate. You move your stops. You start looking at all these wicks. You revenge trade. You forget where all your moving averages are. You throw everything out the window. You're staring at your P&L. You're staring at the ticker, and every single penny becomes a life and death struggle. When your size is small, you tend to follow your plan. You stay calm, you execute cleanly, and you find out that you're actually able to hold your trades through the ups and downs and let it capture as much of the gain as you can because you don't got those sweaty palms. Guys, position sizing is a real simple formula, all right? You think of your account size, how much position size you're going to have in your stop distance. So this is just a little bit of a cheat sheet for you guys. Let's say that you've got yourself a $10,000 account, right? And you want to risk $100 per trade. So what you're going to do is just give yourself a little bit of a cheat sheet. If you have a 10-cent stop, you can have 1,000 shares, right? If you have a 20-cent stop, you're going to have 500 shares. If you have a $1 stop, you're going to have 100 shares. So something just real simple like that will allow you to size properly and quickly. When you have a cheat sheet like that, it takes some of the thinking out of it. Even in the heat of battle, you're able to get the proper shares in the sizing you need for your account. Consistency, that's what really compounds. Big swings destroy mentally and your physical capital. Guys, if you lose 25% of your account, if you're at 50,000 and you go to say 25,000, you lose half your account. Well, guess what? You got to make 100% return to get back to 50. So your 50% loss means you got to do 100% to actually get it back. The numbers don't work when you're looking at big swings. The math does not play out. You don't need huge winners every day. You need to put yourself in a position where you could find that big winner. But in the meantime, you're taking the base hits, the doubles, sometimes a triple, and you're building that equity curve over and over, slowly but surely. That's when things start to compound, right? That's when you're going to be able to get some real progress. First, you're just spiking and crashing nonstop. Now, look, we're not pikers. We're not here to just play for pennies. At some point, you want to get into the big game. There's going to be a time to size up. Most traders have to size up, but they got to do it from consistency. You know, how I think about it is, month one, you're doing good. Month two, you're doing a little bit better. Month three, you're doing pretty good. And you slowly start to size up that position as your account grows, but you're also able to playbook your best setups. So the consistency allows you to size up. It allows you to gain the confidence because your account size will also be slowly going up. So your size will go up with it. And then you can add a little mustard on it if you need to, because you've earned that right through consistency, through profits. Your $30,000 account is now $50,000 after 3 months, 4 months. Well, guess what? Your size is going to start to increase too, but then it puts you in the game for some earned size where you actually do have an opportunity to go for it. Guys, most traders use the same risk for every trade. And that's great for mathematics and making videos, and it's really good when you're a brand new trader. But markets don't give equal opportunities every day. Some setups are just average. Some setups are rare. What you want to be doing is putting yourself in the position to go for gold when you actually see it. So yes, in the beginning, maybe you are doing a 1% risk, and you're just doing it for months and months and months while you build the consistency and your account starts to grow and you prove yourself. But at some point, if you have a higher probability setup, you can add size to it. So if you have a 1% risk and you're just taking some really good trades, that's great. But what happens is as you start to earn the right to have more size, say you have a high probability setup, something with a 70, 80% win ratio, and you got a huge RR on those trades historically. I like to track my trades through TradeZilla. That's how I like to do it. And you got to find some journal where you're able to track these trades. But if I see a high probability setup that's just like really, really unique, I might risk 3 to 4% on that trade because it's a unique opportunity. Now, I will only do that on a setup that shows around, like, let's say once a month, right? It has to be something that's a rare setup. And then I start to increase my risk. For example, if we saw the move in silver, right, the last month or so, that was such a rare, like once in a decade occurrence that like that specific short setup when it went parabolic like that, that's something where I would take a bigger position because when the collapse comes, it's going to be epic. When you look at a chart like silver, like this is like a huge parabolic move, right? So when this setup showed a rubber band setup, which is my classic like counter trend setup, you can go in for a bigger size on something like that because you're going to see like inherently like a bigger pullback, right? You're seeing an outlier move, something that you don't see very often. So in those particular cases, you can actually go in with some higher size. One of the things to do when you do have one of these unique opportunities is you want to increase the size with confirmation, not emotion. If you're going to stretch out your risk into that, like say 3 to 4% in a trade, what you need to do is take a starter position where you have maybe a 0.5% risk on the table. And once it starts to prove itself, then you start to add it and you take it to 1, then it starts to prove itself, then you could take it to 2, and you can get into that bigger size gradually, but the initial setup, the initial entry, you're probably going to actually have less than 1% risk as you put the feeler out. Guys, if you master risk, everything changes. Your emotions improve, your consistency improves, your confidence improves. Get this right and everything else becomes easier. We all want to make money so fast, so we go for gold because we're trying to make back past losses and get to our goals faster. But what you have to remember is the easiest way to get where you want to go is slow and steady. Because if you start to have big fluctuations in your P&L, it becomes very hard to make back those drawdowns. If you get risk right, if you get your risk right, everything becomes easier. If you get your risk right, everything else gets easier. Subscribe. We're building this the right way. Trust me on this. Do it the slow and steady way. You're going to get where you need to go.